Welcome to Doc Tickers. You're tuning in for your shortcut to understanding the crucial numbers and narratives driving today's market.
And today, we're doing a deep dive into CBL International Limited. That's ticker BNNL.
Right. They're a marine fuel logistics company, part of the Bonnet Group, and they just dropped their fiscal 2024 earnings.
Yeah, and there's quite a bit to unpack here. Let's jump straight into the results snapshot.
Okay, hit us with the highlights.
All right. So fiscal 24 saw some really significant growth areas for CBL. Sales volume, for instance, jumped 38.1%.
Pretty substantial.
Yeah, and that fueled revenue growth of 35.9%, bringing them up to $592.5 million.
Yeah.
Their cash balance also saw a decent bump, up 8.3% to $8 million. And operational cash flow, that surged over 80%.
Okay, so operationally things look strong on the surface.
Very much so in terms of activity. And their footprint expanded too. Port coverage grew by over 70%. They went from 36 ports to more than 60 across 14 countries now.
60 ports, okay. Big expansion.
Huge. And maybe the headline grabber, their biofuel sales volume. That saw an incredible surge, over 600% year over year.
600%. That's massive. But I sense there's a but coming. Nearly 36% revenue growth sounds amazing.
There is a but, you're right. While that top line growth is, really impressive, the bottom line tells a different story.
Mm-hmm.
CBL actually reported a net loss for 2024, $3.87 million. That's a swing from a net income of $1.13 million back in 2023.
Ouch. So a loss despite that big revenue number. What else?
Well, tied into that, gross profit also declined. It was down about 25.5%, dropping from $7.21 million to $5.37 million.
Okay.
And operating expenses, they climbed quite sharply, up 56.8%, hitting $8.7 million.
Right. So the top line looks great. Big revenue jump, huge expansion. Mm. But that net loss definitely raises some eyebrows. How does that happen? What's driving that sort of contradiction?
It's a classic growth versus profitability story, really. That revenue boost, like we said, came from expanding their supply network and getting more customers.
Right, more ports, more sales.
Exactly. Geographically, the biggest gains were actually in their others category. That's places like Europe, Japan, Vietnam, Thailand, up a whopping 291%.
Wow.
South Korea also jumped 187%, Singapore up 102%. Even China, their biggest market at, over half their revenue, still grew a solid 38%.
Okay, so growth was broad-based, but the loss?
The loss comes down to a few key things. First, that drop in gross profit margin. They mentioned making a strategic pricing adjustment.
Meaning they lowered prices.
Essentially, yeah. Likely to win that market share, attract those new customers during the expansion phase. The higher sales volume helped, but it just didn't fully make up for the lower margin per sale.
Got it. Factor one, lower margins.
Factor two, those higher operating expenses we mentioned, that 56.8% jump, that reflects the cost of the business expansion itself, setting up in new ports, personnel, logistics, plus specific investments in their biofuel operations, which are new and growing, and also putting money into enhanced ESG initiatives, environmental, social, governance stuff.
Okay, so expansion costs, biofuel ramp up, ESG spending. Anything else?
Yeah. Third thing was a rise in interest expenses. So you put it all together, lower margins on sales, significantly higher costs to run the bigger operation and invest for the future, plus more interest paid. And that's how you get a net loss despite selling a lot more fuel.
Right. Makes sense. Investing heavily now. You mentioned those big investments in their global reach. Tell us a bit more about that operational expansion. Where are they popping up?
They really pushed out globally, over 60 ports now, spanning Asia, Europe, Africa, and even Central America.
So pretty much worldwide coverage building up.
Yeah, some key highlights they mentioned were starting biosupply in major Chinese ports like Guangzhou and Shenzhen. That's a big step there. They also did their first ever biofuel supply in Portland, Malaysia, added Mundra port in India, which is significant, and boosted their presence in really key global hubs, the Amsterdam, Rotterdam, Antwerp area in Europe, Mauritius off Africa, and Panama in Central America. Strategic spots.
Definitely hitting major shipping lanes. And what about their actual customers? Is it still mostly the big container lines, or is that changing?
That's actually shifting quite a bit. They've diversified. Customers outside the container liner segment, think tankers, bulk carriers, et cetera, now make up 45% of their base.
Oh, interesting. Up from what?
Up from 32% in 2023. So that's a significant move towards diversification. Container liners are now down to 55%.
Still the majority, but less dominant.
Exactly. But it's important to note, They still serve 9 of the top 12 global container shipping lines. That represents something like 60% of the entire global container fleet. So they're keeping those major relationships while broadening out.
Good strategy.
Yeah.
Okay, let's talk sustainability. It's huge in shipping now. What's the latest on their biofuel initiatives? You mentioned that massive sales jump.
Yeah, this is clearly a huge focus area for them. They've made real strides. They launched their B24 biofuel. That's a blend that cuts greenhouse gas emissions by about 20% compared to traditional fuel.
B24. Okay. And where are they supplying that?
They've expanded supply to Malaysia, Hong Kong, various ports in China. And significantly, they did their first B24 supply in Singapore just back in March.
Singapore is a massive bunkering hub, right?
Absolutely. Getting B24 into Singapore is a big deal. And remember that 600% plus sales volume increase year over year for biofuels. That speaks volumes about the demand and their capability.
You're sure. Was backing that up. Any certifications?
Yeah, they highlighted their ISCC EU and ISCC Plus certifications. These are key. They basically guarantee the sustainability and traceability of the biofuel feedstocks they're using, builds trust.
Good. Are they looking beyond biofuels too?
They are. They mentioned they're actively evaluating other sustainable options like LNG, liquefied natural gas, methanol, and even hydrogen for the future. So they're trying to position themselves for the longer term energy transition in shipping.
Okay, so lots happening. You've got this strong revenue growth, but a net loss. Major global expansion, but rising costs.
Yeah.
A big push into biofuels. What's the overall game plan look like for, say, 2025, based on what they said?
Well, their strategy for this year seems to be built on several pillars. First, keep expanding the service network, especially focusing more on Asia and Europe, and maybe dipping into some emerging markets.
More growth.
Definitely. Second, maximize sales volume within that network and really strengthen relationships with suppliers, core blocking and tackling. Third, keep pushing biofuel adoption hard, building on that early success, and continue exploring those other sustainable fuels like methanol.
Okay, growth, sales, green fuels. What about fixing the profitability issue?
Right, that's crucial. They aim to improve gross profits partly through just more sales volume, but also by using their bigger network more efficiently to manage supply chain issues or disruptions. They also explicitly see biofuels and potentially other alternative fuels as routes to higher margins down the line.
Interesting. And financially, how do they support all this?
They stressed maintaining a strong cash position. They'll be looking at capital market opportunities, maybe more offerings, and also traditional bank financing to make sure they have enough liquidity for operations and investment.
And efficiency.
Yeah. Lastly, they mention investing in automation and IT systems to try and streamline operations and, hopefully bring down some of those operating costs over time. It sounds like a plan to leverage the growth while tightening the belt and focusing on higher margin products.
They also really emphasized their financial flexibility in the call, didn't they? Sounded like they wanted to reassure people on that front.
They absolutely did. They pointed to their, relatively healthy cash position, having enough bank facilities available, keeping debt levels low, that improvement in operating cash flow we saw, and using just-in-time inventory management to avoid tying up too much cash.
And they've been active in the markets recently.
Yes. They mentioned a private placement back in August 2024. Then they filed what's called a shelf registration statement in January 25 that basically lets them issue more shares more easily later.
Right.
And they followed that up with an at-the-market or ATM offering in February 25.
Okay, so tapping the equity markets. What are they using that cash for?
They stated it's for general corporate purposes, which is broad, but they specifically mention funding network expansion, pushing the biofuel business, potentially looking at acquisitions, paying down some debt, and just supporting working capital. Standard stuff for a company in growth mode.
Okay, so boiling it all down after that deep dive, what's the key takeaway for someone trying to understand this earnings call? What's the core story here?
I think the core story is aggressive growth and strategic positioning for the future, even at the cost of near-term profit. The huge revenue growth shows they are expanding their market share significantly.
But the investments are costly.
Exactly. The heavy spending on expansion, biofuels, and ESG shows they're betting on the future, aligning with where they think the marine fuel market is heading, especially around sustainability and maybe future regulations.
And the biofuel success seems real.
That 600% jump is hard to ignore. It shows they can execute and that there's demand. Expanding the port network also shows agility. So for you listening, the key thing to watch going forward is, can they translate this growth and these investments into actual profit improvement.
Right. Will those margins recover? Can they control the OpEx?
Precisely. Their 2025 initiatives are all aimed at that, so execution will be critical. Also, that customer diversification is a positive sign, making them less reliant on just one sector. And, they even touched on navigating things like the Red Sea crisis, showing some operational adaptability in a tough geopolitical climate.
All right, now for our favorite segment. This is not financial advice, where we get a little creative. Based on everything we've just discussed about CBL International, give us an outrageous but plausible trade idea.
Okay, here's one for you. Let's call it the Green Lanes Gambit.
Ooh, I like it. Go on.
So you look at the projections for the green marine fuel market. Some analysts are talking massive growth, like a 50% compound annual growth rate, maybe more.
Huge potential.
Right. And you see CBL with this massive 600% plus surge in biofuel sales already. They look like an early mover with momentum. So the outrageous but plausible idea is go long CBL International, BNNL, betting they continue to capture a big slice of this booming green fuel pie.
Okay, that's the long side. What's the hedge or the other side?
Pair it with short positions in some legacy bunker fuel providers, maybe traditional refiners or suppliers who seem slower to adapt, who haven't shown the same kind of push into sustainable fuels yet.
So betting on the disruptor against the incumbents.
Kind of. The idea is if this green transition really takes off as fast as some expect, a company like CBL could potentially grab disproportionate market share, maybe leading to a re-rating, while the laggards get squeezed. It plays on that whole market shift dynamic.
The Green Lanes Gambit. Definitely outrageous, maybe plausible. Got another one.
How about the geopolitical arbitrage?
Intriguing. Explain.
Okay, think about CBL's expanded network. They specifically mentioned adding presence in places like India, Panama, Mauritius, the ARA region.
Key spots, especially with recent shipping disruptions like the Red Sea issues causing rerouting.
Exactly. So they're now better positioned in some of these locations that are seeing increased bunkering demand due to ships taking longer routes. Combine that with their mention of strategic pricing. The trade could be go long CBL, betting they can capitalize on these ongoing global shipping disruptions by being in the right places at the right time, providing essential fuel. And maybe hedge it slightly, perhaps with a short position in a broad shipping ETF.
While the short on the ETF.
The idea there, the speculative part, is that while disruptions might benefit a strategically placed supplier like CBL in certain locations, the overall shipping sector might face headwinds from increased costs, longer transit times, and general instability. So CBL could potentially outperform the broader shipping market during these messy periods.
Right, trying to isolate CBL's potential advantage from the general market movement.
Yeah.
The geopolitical arbitrage. Another one to chew on.
Again, purely speculative scenarios based on the call's details.
Absolutely. And that brings us towards the end of our deep dive on CBL International's fiscal 2024 earnings. We've covered that impressive top-line growth, dug into why they posted a net loss, looked at their big push into biofuels and new ports, and even tossed around a couple of speculative trade ideas.
It's a company in transition, clearly focused on growth and positioning for a greener future in marine fuel.
Definitely one to watch. Now remember, everyone, what you've heard today is just our analysis based on the earnings call and information. It is absolutely not financial advice.
Please, always do your own thorough research and due diligence before making any investment decisions.
We really hope this deep dive gave you some valuable insights into CBL International. Join us next time on Talk Tickers, where we'll break down another key earnings report.